Hello, test test. Hello, hello. Very good morning to all, and happy Friday. Welcome back to today's daily dose of market insights. I'm Kelvin here again. Very good Friday and happy Friday. Today will be the 6th of June 2025. So let me do a screen check first. I hope that everything is working. All right. So I believe that the screen is doing fine. All right, great. So before we get started in today's gist of today's daily dose, which is quite a volatile session yesterday. So let's have a quick look at the disclaimer first. Okay, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the intraday technical outlook on the major US dollar pair, the major stock indices, as well as the two key commodities market that we cover on a daily basis, gold and West Texas crude oil, let's have a recap of yesterday's very interesting and volatile session across the board, starting with the key economic data news flow that has taken shape yesterday, and as well as in today's early Asia session that has an impact on the respective intraday movement of these respective cross asset classes. So let us start with the movement of the FX market first yesterday. So what you could see over here is that yesterday in the European session at 5:45 p.m. Singapore time, we see a synchronized sell-off in the US dollar over here. So the dollar actually plummeted against other major currency, which is also came in line with our expectation in with regards to the ECB monetary policy decision that was actually due yesterday. So still recall in my daily dose of market insights yesterday, we do have a bullish bias on the euro dollar and the sterling dollar, anticipating this intraday weakness on the US dollar as the ECB monetary policy decision took hold. And the reason why the dollar sold off during the start of the sell-off took shape at 6:35 p.m. Singapore time yesterday. It went all the way down to 10 p.m. Singapore time yesterday. So between this short-term, we call it 2 hours time frame, that is intense US dollars selling off against the other major currency. It all boils down to the forward guidance from ECB. So why do I say that? So ECB yesterday mentioned that, or ECB officials yesterday highlighted that there could be a potential July pause, and with some seeing rates ending at 2% over here. So yesterday, within market expectation, ECB actually cut the depo rates over here, the depo rates to to previously it was at 2.25%, and it came down to 2% as within market expectation. And right now, the forward guidance coming out from ECB stating that next month, July, they may not continue to actually cut interest rate anymore. And what we could understand over here is that this was, I think, the 7 or 8 consecutive cut over here since last year. So let me highlight to you guys. All right. So if we go to the 5-year trend, right. So this is the, I think, the 1, 2, 3, 4, 5. All right. So this is the, I think, the 7th cut, the consecutive cut so far by ECB. So what's interesting over here is that the latest forecast coming out from ECB, because ECB has also issued their key economic forecast to guide them in their in their next monetary policy decision. So if we look at inflation excluding food and energy, which stripping out the volatile item, the one highlighted in black is the March forecast. The one highlighted in dark pink or bright pink, I would say, is the forecast made yesterday. So the forecast made yesterday among the ECB officials, the media forecast, they expect inflation in ECB, excluding food and energy, to be up slightly by 2 basis points in 2025 this year. So there was an upgrade in this inflation forecast, excluding food and energy, from to 2.4% from the previous forecast made in March, which is at 2.2%. So given this slight upgrade of inflationary pressure, excluding food and energy, it also did imply that ECB should be very near its monetary policy cutting cycle. And also due to this upgrade in inflation ex food energy forecast, ECB potentially could be on guard for imported inflation coming back, hitting back into the Eurozone, pretty much driven by the uncertainty surrounding the current US White House administration uh, tariffs policy against the rest of the world. All right, and no change in GDP growth. So GDP growth, ECB is expecting it to be at 0.9% for 2025, similar as the forecast made earlier in March. But however, there is a slight downtick for 2026 forecast, GDP growth forecast in Eurozone, 1 basis point lower to 1.1%, the latest forecast made yesterday, from 1.2% from the previous forecast tabulated in March. And no change for 2027, remains at 1.3%, right, in terms of the economic growth forecast for 2027. So not really much of a clear uh, growth deceleration that is being expected in GDP. And one of the reason why is that because of that ambitious fiscal stimulus policy that is coming out from Germany starting from this year. All right. And what's interesting over here is that let me touch on the FX market again, because since we're at FX, at the start of today's Asia session, that means i.e. at 6 a.m. Singapore time, there's actually a big bounce in the dollar yen. So right now what we could see over here is that the dollar yen is actually the leading US dollar major currency, where the dollar is up by 0.13% against the yen, based on the 5-day rolling performance basis as we are speaking right now, 6th of June. And if you look at the 1-day rolling performance, very clearly the dollar yen is the kind of the outlier right now at the top, where you can see. So the reason why the dollar yen has kind of shaped this minor rebound as we are speaking at the start of today's Asia session was a rather disastrous household spending out from Japan that was released much earlier before the start of our daily dose today at 11 a.m. So the release was at 7:30 a.m. Singapore time over here. Right, so take this as household spending is a bit like a proxy of retail spending, consumer retail spending. So from on a both on a year-on-year basis and a month-on-month basis, it actually dropped more than it actually dropped disastrously and came in way below expectation. So based on a year-on-year basis that strip out of seasonality factors, for the month of April, market is actually expecting only a slight slowdown to 1.4% year-on-year, still growing at 1.4% year-on-year, down from 2.1% year-on-year for March. But however, it came in at a negative year-on-year figure, negative 0.18%. And as for the month-on-month basis, which is much more volatile, it came down also way below expectation. Market is expecting a decline of a negative 0.8% month-on-month basis from a positive growth of 0.4% month-on-month in March, but it came down steeply at negative on the downside at negative 1.8% month-on-month. So if you look at the household spending trend in Japan by showing you the trend over here, so this April print is rather disastrous over here. Okay, this marks the second year-on-year decline spending so far this year. So if you go to the 10-year, so it's now looking up at a lower high over here, a lower high. Right, so this is the second time in 2025 it dipped down to the negative territory. The previous time was in February this year at negative 0.5%. So with this rather a weak or soft print in the Japan household spending on a year-on-year basis, so that could potentially alarm several Bank of Japan officials to actually hold guard to prevent them from potentially there might be a much more fiercer discussion in the next BOJ meeting, that some of the BOJ dovish officials may urge their hawkish counterparts not to raise interest rate this year in Japan. So that actually explains the intraday rebound that we are seeing right now on the dollar yen. All right, so that's for the FX market. So let us discuss the very volatile movement that was being seen on the major US stock indices yesterday. So if you look at the major US stock indices yesterday, at the start of the US session, there was actually a strong rally. But in the SPX initially it dipped down to 5,950. Then thereafter it almost rallied and hit the psychological level of 6,5999. Then after hitting 5999 at the 12 a.m. mark Singapore time, that means early Friday, the market or the US S&P market, S&P indices continues to dwindle downwards and close in the red. So what I could see is that across the board, from 12 a.m. onwards Singapore time, even at the Nasdaq 100. Okay, give me a minute. It seems to be very slow. Okay, give me a couple of seconds. Okay, why is it not showing? Okay, Nasdaq 100. Okay, 12 a.m. There also a sell off in the Nasdaq 100. Dow Jones Industrial Average, similar as well at 12 a.m. There was also a sell off as well. So at the end of the US session, all the major US stock indices closed in the red. The SPX down by negative 0.5%, the Nasdaq down negative 0.8%, the Dow Jones down by negative 0.25%, and the Russell 2000 almost unchanged at negative 0.05%. But what's interesting is that yesterday in my daily dose of market insights, we do expect a bullish bias. So the bullish bias actually staged that indeed that rebound in the first half of the session, and despite that intraday sell-off from 12 a.m. Singapore time, both the Nasdaq 100 and the Dow Jones Industrial Average didn't break our respective short-term pivotal support that I highlighted yesterday. So later I'll touch on more on the intraday technical outlook on these indices, and from now onwards, due to popular request, I will also include the intraday technical outlook for the S&P 500. So do stay tuned later in the second segment of today's daily dose. And also, let me explain what causes the initial pop-up or the initial bullish pop-up in the major US stock indices at the start of yesterday. At the start of yesterday's US session, that means we in the first half of the US session yesterday, was this possible optimistic US-China trade relations. So why do I say so? So yesterday, where is it? Yeah. So yesterday, both sides released respective press statements saying that the two key superpower leaders in this ongoing fight between the we call it frosty relationship between US and China, President Trump and China presidency actually spoke on the phone. Both of them, it's a one-to-one talk that lasting for about an hour or so, and they agree to more trade talks as a rare earth dispute cools. All right. So basically, the key takeaways is that U.S. President Donald Trump and Chinese President Xi Jinping agreed to further trade talks to resolve dispute over tariffs and rare earth materials. Because last Friday, both sides of them accused one another, stating that they don't hold on to their respective terms that was agreed in earlier last month in Switzerland on that 90 days trade truce between these two countries, as they try to potentially resolve some rather complex thorny issues. All right, so the two leaders has a 90-minute talk. All right, then during which Trump acknowledged that the trade relationship with China had gotten a little off track, but said that they are now in a very good shape. But there is no timeline that is being mentioned on how what will be the potential next step will be. All right, so the call generated some hopes on Wall Street for lower duties between these two superpowers, but investor optimism was limited. Questioning remained about what concessions Trump made to Xi and whether Beijing will speed up the export licenses on rare earth magnets to US. That is, this rare earth is a very key ingredient for US in terms of their EV industry and as well as their high-tech defense industry. So nothing much detail came out from that. Just Trump and both sides just released their own individual press statement stating that the two leaders has a one-to-one talk on Thursday, and based on whatever Trump said, that he's saying that now they are in very good shape. So still a lot of ambiguity going forward, but nonetheless, market still has that initial optimism that causes the pop up in the major US stock indices at the first half of the US session. And now let me explain what happened in the second half of the US session from 12 a.m. onwards exactly. So this 12 a.m. onwards in the US session that causes the major US stock indices to sell off, especially in the S&P and the Nasdaq 100, is due to the tremendous 14% decline intraday on one of the mega cap stock, which is Tesla. Okay, so this what happened in Tesla. So in fact, Tesla has been in a very underperforming mode among the major cap stocks in the last 1 to 2 months or so, and right exactly at the 12 a.m. mark, you can see over at my cursor over here, there was a steep sell-off in Tesla, and this steep sell-off in Tesla at the top panel of your screen of here also synchronized with that steep intraday sell-off in the S&P 500. Top chart, black and white candle, intraday hourly chart of Tesla. Bottom chart, green and red candle, intraday chart on the S&P CFD index in our OANDA platform. So right exactly at the 12 a.m. mark this Friday time, Singapore timing, we start to see a synchronized sell-off between Tesla and the S&P 500, given the fact that why Tesla has a negative feedback loop into the S&P, because it's one of the 7 mega cap component stocks. And one of the reasons why Tesla actually sold off is due to this ongoing public dispute among two high profile personality, I would say, is Elon Musk and Donald Trump, each another accusing one another of all pertaining to that one beautiful tax bill that Trump is pushing up for to be approved in Congress. So it has been approved in the lower house of the Congress, which is the House, and now this week is due for a debate in the Senate. And Musk himself starts to actually made a lot of negative comment about the tax bill, saying that it will actually make US in a much worse position due to the budget deficit. But the clear story over here is that why Musk have this public fight with Trump is because of the conflict arises concerns due to Trump potentially retaliating against Musk company that could impact Tesla market value and its ability to deploy autonomous figures over here. And because of the main reason why Elon Musk is so publicly against Trump bill is because it will hit his personal wealth as well. Why? Because Trump tax bill will eliminate a credit worth up to 7,500 for buyers of some Tesla model, and potentially based on estimates that could result a 1.2 billion hit to Tesla full year profit this year. So that actually causes the of Elon Musk negatively condemn Trump's we call it one beautiful big tax cut bill. And because Trump was so frustrated with this, there was a back and forth accused of one another. So this will happen. Trump mentioned that he's very disappointed with Elon. Then he said that I asked him to leave. He just went crazy. Then from Elon Musk said he accused Trump back that without Trump he will lose the intention. And thereafter there was actually also at the end of the day there was actually a potential what I call it decommissioning of government contracts that Elon Musk related companies that could have. So that causes the Tesla share price to actually plunge tremendously from 12 a.m. onwards Singapore time. But however, right in early Asia session, Elon Musk made in a public comment in his Twitter X account, signaling that he's open to cooling off period with Trump. All right. So with that record remark over here to cool down yesterday's tension between these two hot-hearted personality, we start to see the S&P E-mini futures and the Nasdaq E-mini futures gaining some ground in today's Asia session. The S&P E-mini futures up by 0.15%. Earlier on, the Nasdaq 100 is also up by I think 0.10%. Now it's back to the unchanged territory. So we start to see a potential pause in yesterday's intraday drop on the S&P and the Nasdaq 100 as we are speaking right now, due to Elon Musk giving a bit of an olive branch, stating that he's open to cooling off between this intense dispute between these two hot-blooded key personality with him and US President Trump. And also yesterday there was also a geopolitical factor or premium news I want to highlight. Risk factor that could go up in geopolitical tension, stating that between this public we call it broadcasted, put it away, that one-on-one exchange between US President Trump and the new German Chancellor in a public address that is being broadcasted publicly in television yesterday. Trump said that he may let Russia, Ukraine fight for a while. So this issue over here has been ongoing, or has already been what's called priced into the market in the last week or so, where we start to see both parties, Ukraine and Russia, staging small scale or even some major scale attacks between some key installation or key places in both countries. So initially last month, where there could be a potential Ukraine-Russia peace talks down the road, and with Trump now publicly mentioning that he will actually allow Russia and Ukraine to fight for a while. So this peace talk between these two countries, Russia and Ukraine, and this conflict have been lasted for close to about 3 years or so, will be kicked down the road, right? Kicking the can down the road. So that actually initially causes the so-called the gold to actually rally to a 4-week high at around the 3,400 psychological level. So if you look at the prices of gold yesterday, on the intraday basis, it managed to ship a high of 3,400. Then thereafter, as it goes down to the US session, it actually sold off, but close, but more like a trading sideways range. So since Tuesday, gold has been trading in a sideways range, but still holding on above the 20-day moving average. So still indicating that the uptrend phase, the what kind of uptrend, the fresh impulsive up move that kick-started from the intraday low on 15th of May, not too long ago, so that's about 2.5 week back, it's still pretty much intact. The price actually managed to hold above the 20-day moving average. All right, so then all in all, in a nutshell over here, yesterday we do have a Federal Reserve official speaking, Fed Kugler. So she's one of the less dovish Federal Reserve official, saying that her main focus now is inflation over here, rather than a potential slowdown in economic growth due to the impact of tariffs on prices. So she expects larger price increases related to tariffs, and supports holding interest rates steady if upside risks to inflation linger on, citing the potential for tariffs to rise inflation over in 2025. So based on the point of view, the current state of affairs in the situation on how US White House administration is implementing their rather erratic, haphazard way of global tariffs policy, that could potentially see higher inflation expectation, and the lagging real inflation numbers in the next few quarters, maybe in Q3, Q4, could take to the upside. So that's her concern which is expressed. So based on everything that took shape yesterday, Trump's so-called one-on-one call with China presidency, we have this ECB officials new forward guidance. We have the latest rise in geopolitical risk premium coming up between the US and Russia current conflict or war, where Donald Trump publicly mentioned yesterday that he will allow Russia and Ukraine to fight up for a while, unfortunately. So taking everything into aggregate, based on the CME Fed Watch tool. So CME Fed Watch tool, for those who followed my daily dose of market insight, I will use this tool to actually monitor the Fed funds futures traders expectation on the forward, the next upcoming Federal Reserve policy, monetary policy decision, and also not only the up and coming one in 18th of June, I also could monitor the next few ones down the calendar as well. By this CME Fed Watch 2, they are able to compare it based on what Fed Funds futures traders expectation, and their expectation are being priced according to the various Fed Funds futures contract, and pretty much unchanged in terms of the Dow for the 18th of June 2025 meeting. Market expecting is still the Fed to stand pat, remains on hold to maintain the current Fed funds target rate at 4.25% to 4.5%. So these are probability based on the Fed funds futures pricing contract, the latest month's one, where CME Fed Watch 2 compile for us. So 97.5%. In fact, there is a slight one basis point increase from yesterday, 96.4%. So put it away that almost 100% we call it expectation based on the CME Fed Watch 2, according to the latest pricing from the Fed Funds futures contract. They expect market participants in the Fed Funds futures expect the Fed to stand pat. And if you look at from a aggregated basis, that means down the next few meeting as in July, September, October, and in December, market participants is also expecting the Fed to maintain stand pat at a high percentage of 66.5% in the July meeting as well, the 30th of July US FOMC meeting. And also the next interest rate cut will be in September, 17th of September 2025 FOMC meeting. So this will be the first cut after a series of pause that took shape this year to bring down to 25 basis points. So that the percentage of probably is quite higher at 98%, almost 100%. There will be a 25 basis point cut to bring it down to 4% to 4.25%. Then thereafter, I will say 50-50. It may cut or it may not cut. But what's interesting over here in the October meeting, but what's interesting over here is that we have a higher chance of 83% for the next 25 basis point cut to be in the 10th of December meeting before 2025 ends, to bring down the Fed funds rate to 3.75% to 4%. So net based on yesterday's yesterday's related news flow, economic data, the Fed funds futures traders is only still expecting 2 interest rate cut in the Fed funds rate before 2025 ends, and the first one is likely to come in September, and that doesn't really change much accordingly to this latest pricing in the Fed funds futures market, and also based on the latest median dot plot in the among FOMC of Federal Reserve officials, where they also pencil in an expected 25 basis point decrease to 25 basis point decrease or cut in the Fed funds rate in 2025 this year. All right, so will this Dow starts to change today? These expectations are today, perhaps potentially it could. Later I'll share with you why, because it will be a key data to look out for today when I touch on the third segment of today's daily dose. All right, so that ends the first segment of today's daily dose. Very quickly, let me now move on to the second segment, which is the intraday technical outlook. Let me expand my screen first. All right, over here. So let us start with the FX market. All right, I hope the screen is moving. Great. So let us start with the euro dollar. So the euro dollar, as expected, did that intraday rally, hit our first resistance as expected as well, before shaping a minor pullback, 114.80. So that is indeed a intermediate resistance where it managed to do a bit of a cap or pause the bullish pressure that is being expected yesterday. So 114.80 intermediate resistance where a minor pullback takes shape. Hourly RSI continues to hover above the 50 level mark, and right now as we are speaking, it continues to trace out a higher high, so indicating that some form of intraday bullish momentum remains intact on the euro dollar. So with that, we will still maintain our intraday bullish bias on the euro dollar using a tightened key short-term pivotal support for today, slightly below yesterday's European session low at 11400 level. So I'll be using 1.14 short tighten short-term pivotal support level on the euro dollar, maintaining that intraday trend bullish bias above 114.80 may expose the next intermediate resistance at 115.65. We saw the one-time Fibo extension taken from the low of 13th of May and confluencing with the minor swing high area of 21st of April, as you could see on my screen here. Only a bearish breakdown with an hourly close below 1.140 at 1.14 level, which is 1.14, that would invalidate today's intraday trend bullish bias to see a slight dip to retest Wednesday low at 113.60. Only a breakdown below 113.60 may trigger off another round of minor corrective decline sequence to retest the 20-day moving average, which is also confluencing with the next near-term graphical congestion support zone at 113 figure slash 112.70. So that's for the euro dollar. Next up, the sterling dollar. So the sterling dollar also squeezed up as expected, never hit our resistance level, almost I would say give or take, it printed a high intraday high of 1.3617, right, slightly below the 136.40 that we highlighted yesterday. Then thereafter, price action did a minor pullback. All right, hourly RSI continues to hover above the 50 level mark over here, so indicating also a positive momentum observation or condition that is still playing out on the hourly RSI as we are speaking right now. So with that, I'll be almost unchanged, still using that 135.35 short-term pivotal support level, which is also confluence with yesterday's European session low, and as well as the pullback support of this former minor descending trend line resistance that I drew from the swing high of 26th of May and 27th of May now turns into a key intraday pullback support. 135.35 short-term pivotal support level for the sterling dollar. Maintain our intraday trend bullish bias. First resistance to watch will be 136.40. Only a breakout above 136.40 may see the next near-term resistance to come in at 136.90, which is 136.90 over here. Only our bearish breakdown with an hourly close below 135.35 that would negate today's intraday trend bullish bias to see a minor corrective pullback, exposing the next near-term support level at 134.80. If 134.80 could not hold, there could be a potential deeper minor pullback to retest the 20-day moving average. We also confluence with the minor swing low of 29th of May at 134.20. So that's for the sterling dollar. Moving on, next will be the Asia Pacific currency against the US dollar, starting with the Aussie dollar. So the Aussie dollar finally squeezed up as expected, hit the upper limit of our medium-term complex range configuration that is in place since 23rd of April at 65.37 slash 65.45. And what you could see now is that the hourly RSI has shaped a bearish momentum condition, all right, by breaking down a parallel ascending trend line and also below the 50 level mark, hasn't hit the oversold region yet. So potentially for today on the intraday basis, starting from the European session here, the US session, there could be a setback towards the middle part of its complex sideways range configuration that I highlighted to you guys earlier, that is in place since mid of April this year. So using the upper limit of this sideways range configuration as my pivotal resistance for today, 65.37 slash 65.45, we will flip to a bearish bias for a potential slide down towards the middle part of this sideways range. Two key support level to watch for today on the intraday basis, 64.75 followed by 64.55, which is the confluencing slightly above the 200-day and the 20-day moving average intersection. So making 64.55 a key inflection level for a potential rebound that could take shape after the price slide hitting this 64.55 level. However, if there is a sudden U-turn or inverted intraday V-shaped recovery and broke above the 65.45 level on an hourly basis, the intraday bearish bias for Aussie dollar will be invalidated, and that could potentially stage a range bullish breakout condition for Aussie dollar to see the next intermediate resistance coming in at 65.80 in the first step, which confluence with this congestion area over here, this minor congestion area of 11th of November and 12th of November last year. Okay, so that's for the Aussie dollar using 65.37/65.45 short-term pivotal resistance will flip to a intraday bearish bias due to the bearish condition that is being flashed out on the hourly RSI now for Aussie dollar that may shape a potential intraday decline towards the middle part of this sideways range configuration. So that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen, like I explained to you, is the strongest US dollar major currency. So price action yesterday hover above our resistance level, did a bit of whipsaw around it. But however, the RSI has started to shift into a bullish momentum condition by flashing out a series of higher high and now managed to go above the 50 level mark and hasn't hit the overbought level yet. So indicating there could be some form of intraday bullish momentum or intraday residual bullish momentum still remains prevalent on the dollar yen on a hourly chart basis, which is on the intraday chart basis. So with that, I will use a rather tight short-term pivotal support for now, which is also the very close to the current Asia session intraday low of 143.46, where we start to see a minor curvature over here, which is 143.35. So 143.35 will be my short-term pivotal support level for the dollar yen. So potentially there could be a residual corrective rebound to retest 144.25. Above it may see 144.80 coming in next, which is very close to the 50-day and the 20-day moving average. And most importantly is the upper boundary of this ongoing minor descending channel that is still in play from the swing high of 13th of May. So I'll be watching very closely once price action of the dollar yen float into this zone of 144.25/144.80, because I deem this zone as a key inflection level where any form of a bearish reversal candlestick starts to appear on the hourly time frame. That could mean that the bearish pressure may have resumed its impulsive downward sequence for the dollar yen going forward. So yes, I am bullish right now for dollar yen, but only for a potential corrective residual rebound scenario, given the fact that the short-term downtrend still remains intact on the dollar yen. Only a sudden breakdown during during the start of the European session, where potentially if there's a bearish breakdown with an hourly close below 143.35, then I would say that the residual corrective rebound scenario will be invalidated to kickstart another potential impulsive downward sequence to revisit 142.35, where the bears can't have a proper breakthrough since 26th of May. Below 142.35 may see a deeper impulsive downward sequence taking hold on the intraday basis, exposing the next near-term support level at 141.65 next. So that sum up the intraday technical outlook on the major US dollar pair. So now let us now turn our attention to the major stock indices, starting with the Hong Kong 33 that is representing the Hang Seng Index. So the Hang Seng Index squeezed up as expected, hit our resistance level at 24,090, and interestingly, we now start to see a bearish divergence on the hourly RSI at the overbought level in yesterday's US session. So price action squeezed up higher high during the start of the US session. Then thereafter, we see a bearish divergence that is being formed on the hourly RSI. And right now, the hourly RSI has really exited from the overbought level and has now slightly inched downwards towards the 50 level mark, hasn't hit the oversold level yet. So what we could see over here is that based on the Elliott wave perspective as well, there is actually a 5-wave sequence up over here, 1, 2, 3, 4, 5, of a impulsive up move sequence may have ended already for the Hong Kong 33. So given the fact that for today's intraday session, there could be a corrective retracement of this minor 5-wave sequence upwards back to retest the 20-day moving average. So given these negative elements on the Hong Kong 33 right now, as we are seeing on the intraday basis, I will be flipping to a intraday bearish bias using 24,090 as my short-term pivotal resistance level for a potential corrective retracement to retest the 20-day moving average, which is confluencing with the minor swing low of 3rd of June at 23,440. A breakdown below 23,440 may see a deeper intraday corrective retracement towards 23,210, which is also this minor congestion area here for Monday. And if we do the Fibo retracement of this 5-wave impulsive up move up from a minor scale basis, its confluence with the golden ratio of 61.8%. So i.e. in a nutshell, the short-term uptrend still remain intact on the Hong Kong 33 given the fact that it's still trading above the 20-day moving average. So what I am expecting now is only a minor corrective pullback or minor corrective retracement to retrace this 4-day plus of rally that has taken shape since the low of intraday low on this Monday, as it has completed a minor 5-wave sequence on the upside with a bearish divergence that's being flashed out on the hourly RSI, indicating there is a slowdown in upside momentum of this minor short-term uptrend phase that was kickstarted in this Monday over here. So i.e. in a nutshell, once price action hit around this zone here, 23,440, 23,210, I'll be looking out for a bearish reversal candlestick to potentially flip back to a intraday bullish bias again. All right, but however, instead, if price action didn't float down as intended, and from this level here, it suddenly shaped a V-shaped recovery and staged a bullish breakout with an hourly close above 24,090, that would invalidate today's expected corrective retracement bearish scenario to flip the honors back to the bulls to expose the next near-term resistance level at 24,490, which is the 0.382 Fibo extension taken from the low of 9th of April, and also this minor congestion area over here of 7th of March and 18th of March. So that's for the Hong Kong 33. Onwards next will be the Japan 225. So Japan 225 continues to trade above our short-term pivotal support level. So it seems to us that it may have now starts to form a sideways range between the short-term pivotal support. The upper limit of the range could be the 200-day moving average, acting as the range intermediate resistance at 37,980. So we will still maintain our intraday trend bullish bias, but within this minor sideways range configuration, unchanged using 37,270, that will be indeed our short-term pivotal support level, because price action also managed to survive in yesterday's US session before staging a bounce up today. All right, first resistance level to watch 37,980. Unless we have a bullish breakout above 37,980, then potentially the bulls could gain more traction to retest the minor swing high area of 29th of May, acting as the next intermediate resistance at 38,460. We saw confluence previously from the minor swing high of 14th of May that kickstarted that minor corrective decline phase. Back towards that, close towards that 50-day moving average. However, if price action has a bearish breakdown with an hourly close below 37,270, that would invalidate today's intraday trend bullish bias within the range configuration and see a slide towards 36,930 next. So that's for the Japan 225. Next up, the Germany 30 representing the German DAX. So the German DAX also yesterday did a squeeze up, almost hit our first resistance before shaping that pullback over here. Hourly over here. The hourly RSI continues to hold above this trend line, ascending trend line support level, hovering around the 50 level mark over here, indicating that bullish momentum still remains intact. So still remains unchanged given the fact that it can't clear above our first resistance at 24,440 / 24,560. I will be still using the short-term pivotal support that I have yesterday at 24,080. Still maintain a intraday trend bullish bias on the Germany 30 for today. First resistance it got to surpass remains unchanged as well for sure at 24,440/560. Only above 24,560 may see the next intermediate resistance coming in at 24,730/24,790. Only an hourly close and a breakdown below 24,080 would negate today's intraday trend bullish bias to see a retest of this Monday minor swing low and this Tuesday minor swing low, acting as the next near-term support zone of the 23,820/23,670. All right, onwards next will be the major US stock indices, starting with this. Okay, give me a minute now. Starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average yesterday hit our upside trigger level, which is the 200-day moving average, before floating downwards, retest the 20-day moving average before staging a rebound in today's Asia session, as Elon Musk mentioned in his Twitter X account that he's willing to actually take a step back in the ongoing heated dispute between him and US President Trump. So still no change. First support level to watch will be at this 42,310 level, where price action is now doing a bounce over here. But the pivotal support level remains unchanged at 42,100 because it can't break above 42,580. So I'll be still having a bullish bias stance on the US Wall Street 30, given the fact that the hourly RSI now is shaping a higher low and now trying to actually fight back above the 50 level mark, indicating some form of bullish momentum condition. So maintaining the intraday bullish bias, 42,100, short-term pivotal support on the US Wall Street 30. Upside trigger level remains unchanged at 42,580. A bullish breakout with an hourly close above 42,580 will increase the the odds of the bullish view to seek out potentially the next near-term resistance zone at 42,870/43,085. If, however, suddenly there's a U-turn on the downside and a bearish breakdown with an hourly close below 42,100, today's intraday recovery scenario will be invalidated to see a retest on last Thursday and this Monday minor swing low area at 41,185, a breakdown below 41,185, potentially see a deeper pullback towards 41,530. All right, next up will be the the Nasdaq 100 over here. So the Nasdaq 100 yesterday managed to clear slightly above the 21,750, but didn't hit the next resistance at 22,050 before that intraday sell-off took place. But interestingly, the intraday sell-off managed to help right exactly at our first support level that we highlighted at 21,500 level. So still no change, still using 21,330 as my short-term pivotal support. We're so confident with the rising 20-day moving average. So as long as this 21,330 short-term pivotal support holds for today, we will still be maintaining our intraday trend bullish bias for a potential recovery in the Nasdaq 100. First resistance to watch on the intraday basis, 22,050. Only a bearish breakdown and an hourly close below 21,330 that would negate today's intraday trend bullish bias to revisit the minor swing low area of last Friday at 21,180/21,015 next. Only a breakdown below 21,015 may evoke a deeper corrective pullback to retest the minor swing low of 23rd of May and 12th of May, acting as the next near-term support level at 20,690, slightly above the key 200-day moving average. Lastly, our new addition to the major US stock indices will be the S&P 500. So the S&P 500, interestingly, yesterday it came close to the psychological level of 6,000, which in terms of technical analysis perspective is the minor swing high of 29th of May as well at 5,997. That sell-off managed to pause right exactly at this minor ascending channel support that I drew from the low of 24th of April, and the hourly RSI also managed to bank off from a parallel ascending trend line support as well. So with that, I'll be using 5,900 as my short-term pivotal support level for today, which correspond to the rising 20-day moving average as well. We will have a intraday trend bullish bias on the S&P 500. First resistance to watch for sure, 5,997. A bullish breakout above 5,997 potentially sees the next intermediate resistance coming in at 6,550 level, which is confluence with a Fibo extension cluster level, and as well as the minor congestion area of 13th of February and 24th of February this year. So only a bearish breakdown and an hourly close below 5,900 will negate today's intraday trend bullish bias to see a minor corrective pullback, exposing last Friday low at 5,850. A breakdown below 5,850 may see a deeper pullback towards 5,805, which confluence with the 200-day moving average. All right, so that sum up the intraday technical outlook on the major stock indices. Very quickly, let us now focus our attention to gold XAU/USD. So for gold XAU/USD right now, as we are speaking, is now attempting a rally again, as it's now staging an intraday gain of 0.53%. Hourly RSI now is inching back upwards towards the 50 level mark after it managed to bounce off from a parallel ascending trend line support level over here. Okay, indicating that the bullish momentum still remains intact for gold XAU/USD. So no change. Yesterday's intraday sell-off managed to hold slightly above our short-term pivotal support level at 3,328. So no change, still using 3,328 as my short-term pivotal support level, maintaining our intraday trend bullish bias for gold XAU/USD on an intraday basis. First resistance level to watch 3,417/3,435, which is the minor swing high area of 7th of May and 8th of May. Only above 3,435 may see a continuation of this impulsive up leg move to expose the all-time high area at 3,490/500, which is also the one-time Fibo extension taken from the low of 15th of May. Only a sudden bearish breakdown and an hourly close below 3,328 that would negate today's intraday trend bullish bias to see a deeper minor pullback to retest the 20-day moving average, and as well as the gap up support level that is being seen in today's in this week Monday Asia session at 32.95. Right, so that's for gold XAU/USD. Lastly will be the West Texas oil. So the West Texas oil continues to trade sideways below our short-term pivotal resistance level at 64.06, which is also the upper boundary of this ongoing symmetrical triangle range configuration that has taken shape since 9th of April low. So still using the 64.06 short-term pivotal resistance level, will maintain that intraday bearish bias for it to float downwards towards the middle part of this symmetrical triangle range configuration. But price action got to break down below 62.74 fast in order for it to expose the next near-term support at 61.85 on the intraday basis. However, if you have a bullish breakout for hourly close above 64.06, that would invalidate today's intraday bearish bias to see a squeeze up to revisit the 23rd of April minor swing high area, which is the next intermediate resistance level at 65.40. All right, so that sum up the intraday technical outlook on all the major cross asset classes. So before we go very quickly, let's look at the key economic calendar. What are the key data to look out for today? So today key data will be centered on the US session. But prior to the US session over here, there's one more Japanese data that we got to take note of at 1 p.m. Singapore time. It will be the leading economic index, a flash one for the month of April. So that could potentially influence the dollar yen rate, and potentially more on the dollar yen rate rather than the Nikkei 225, because market expecting a slight downward drift to 104.1 from 108.1 that was printed in the previous month of March. Then thereafter, as we head into the European session, we do have retail sales from Eurozone, something to take note of at 5 p.m. Singapore time. And those who are looking at the dollar Canada rate and the CAD crosses, you have key labor data up from Canada, unemployment rate and full employment change at 8:30 p.m. And the most important one will be the focus will be on the US labor data, which is the non-farm payroll data and unemployment rate. So for the headline non-farm payroll data, market expecting a downward drift to 130K from 177K printed in the previous month of June. Employment rate, however, market expecting to hold steady at 4.2%. Then thereafter it will be a rather quiet US session. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great weekend ahead. Do rest well, and we shall speak again on next Monday. Thank you.